I get this thing to do what I want. Good morning. Today is March the 12th, 2023. And we are running a little bit behind schedule. Thank you for joining me this morning. Today is the day after daylight savings, or day of the daylight savings spring forward. So forgive me if I'm a little jet lagged. Um, the morning after the time change is always quite difficult. Statistically, I think the incidence of car crashes, heart attacks, and workplace and industrial accidents all increase the week or 2 weeks following the spring forward and the subsequent loss of an hour of sleep, which is it's a remarkable thing when you think about it, right? Obviously, for each of us, the impact is very minor. Okay, we're a little bit more tired, but collectively, with enough people. There's some people where that just pushes them over the edge of, um, not being aware or overly fatigued, whatever, that causes them to have accidents, both the vehicular variety and in the workplace, as well as increasing, I guess, their stress levels and thus the heart attacks. I'm not sure why that happens, but it's a crazy thing to think about. It speaks to the interesting way in which things that don't seem like they are connected are connected. And that kind of brings me to what I would like to talk to you about today. There's been a lot of news, a lot of talk. Maybe you've heard, maybe you have not, about the Silicon Valley Bank being insolvent, or at least unable to fill deposits and shutting down operations. And it, I guess rightly so, has a lot of people worried. A bank run is a thing that has happened historically. And I mean, it happens all the time, really. If you look around the world, and it's 200 something countries, it does happen much more often than it should, certainly. And a bank run, in case you don't know, is when, well, really quickly, the way a bank works, we have what are called fractional reserve banks, which is the kind of banks you have in the world today. They have a fractional reserve. So if you give them a deposit, they must hold on to some percentage of it, but the rest of it, they take and lend out as mortgages and other financial products to make a profit. So when you deposit $1,000, fractional reserve bank might keep 10% of it in deposit for you, and $900 they will package together into, for example, a mortgage, and then to me when I purchase a house, for example, right? And so that's how our banks work. And so a bank run is when many or all of the depositors come to the bank and want their money back at the same time, right? The way the bank operates is it assumes that on any given day or at any given time, only about 10% of its customers are going to want their funds, or their customers are only going to want about 10% of their funds. And actually, no, it'd be like they want 5, but we're keeping 10% on hand just in case, right? Of the funds that we have available on deposit. But if everybody comes to withdraw their funds, then they want much more than the 10%. And this is a bank run, because now the bank does not have the cash on hand to actually give to these people, right? The cash is in a mortgage in a house, and the bank can't get it for you today if you're trying to make a withdrawal, right? They need to either sell that mortgage to another financial provider to generate the cash to give to you, or they need to wait out the term of the mortgage, right? So the bank is in this, they're stuck in this position where they don't have your money, but you want your money. Everybody wants their money, and they don't have it. So that's what we call a bank run. And these have happened in history. And often a bank run can lead to a bank panic, a banking panic, right? Where multiple banks are insolvent and people are running to them to get their deposits. And so people lose confidence in all the banks and they run all of the banks because they all work the same way, right? That's a thing that has happened. Not really in recent history, but it was certainly an issue at the beginning of the 20th century and prior to that. And so bank runs are they're very bad. They're very, very bad. They basically, if they happen, they shut your economy down. It's almost like your economy is having a heart attack. That'd be like the right analogy. It's like all the flows of money that make up your economy get choked, right? And so, I mean, you can imagine, right? A bank that is experiencing or on the verge of a run, right? Doesn't have any money to lend to prospective businesses or debtors, right? And that's how they make their money. So they're in a really, really tough position, and oftentimes banks fail. So in the case of the Silicon Valley Bank, which is obviously located in the United States, the first thing is, I'm speaking from a Canadian context, so assuming you are coming from a Canadian context, in Canada, there's more or less a banking cartel. We have maybe five plus one big banks, right? That are more or less hold a monopoly or oligopoly charter from the government. They do have smaller competitors, so the picture is not so simple as it's these banks are just in control, but they have more than 80%, and they're again is the Pareto principle, but they have more than 80% of the market share in our country, and actually they're some of the largest banks in the world, the Canadian banks. Those banks are very heavily regulated, and there are very few of them. They are very, very large. Like I said, some of the biggest banks in the world. And so their context is quite a bit different from that of the Silicon Valley Bank in the United States. And I think the name betrays that a little bit. It's not the Bank of America or something like that. It's the Silicon Valley Bank. So it's a regional bank. And America has thousands and thousands of these because they have much more market competition in the banking sector than we do. Still probably less than I think a lot of their economists would like, but more than we do in Canada. So this is just one of many, many banks. And so if this were to happen to one of the Canadian big five banks, that would be a very massive deal for the Canadian economy and would probably cause a panic at the other banks. Whereas in the case of America, this is more contained. It still has the potential to scare people and get people stampeding to the banks, but it's less likely to do so. And we haven't seen that happen. So it doesn't look like something like that is going to happen unless more banks begin to fail. But this bank and its failure represents probably the first of many to come. Not necessarily all of them will be banks, but a lot of financial institutions collapsing and the businesses associated with them. And so I want to explain how in real estate, the interest rates that we're looking at in borrowing and lending, how those connect to what's happened to this SVB bank, right? And kind of why the fates of investors in this bank, they're tied together. We can call it a canary in the coal mine. I think that's a little dramatic, but it indicates that the market is perhaps not as rosy as it's being made out to be by the talking heads and the politicians who want to paint a picture of perfection. So the closing of this bank or the failing of the bank as such is really a consequence of the market conditions we see with increasing interest rates and a generally sluggish economy, right? We have those things paired with inflation. And so businesses, assets, assets, yes and no. Businesses, certainly. And of course, households are being hit very, very hard by the increase in interest rates. Most of the world, the modern Western world, pardon me, runs on has been financialized in some sense or another. Many businesses are running their payroll on credit products provided by their financial providers, or they're getting inventory that way, right? And so there's a lot of credit in the market, and this credit is not like a mortgage where it's a secured, defined rate over a period of time. At least if you go for that type of mortgage, it's variable debt, right? It's credit cards, lines of credit, business lines of credit, those types of things, right? And when the interest rate increases, obviously the payments and the debt service on those things increases. So if we have a bank, right, like the Silicon Valley Bank, and it's primarily startup and investment focused, right? So this bank has on its asset sheet, right, because it lends out money to get assets, to generate income, to pay out its depositors interest and make its profit. That's what the bank does, right? So it's taking its depositors' money and lending it out to basically startups or just past startups, and kind of helping those companies grow and then reaping the returns on that investment. So if they have 100 companies that are each worth $1 billion, right? They have a $100 billion balance sheet, right? They're worth $100 billion worth of all these companies that they own, right? Now, in a low interest rate environment, right, if all of those companies are heavily financialized and they've taken on a lot of debt to, grow and invest and build for the future and do all the good things that a company's supposed to do with debt, right? We're not saying they're misusing the money they've been allocated, right? But if we say that, then each of those companies is carrying hundreds of millions of dollars of debt based on their valuation, and they have to service that debt. And now their interest payments are doubling, right, over the course of a year, and so their debt service is subsequently almost doubling as well, right? And that means they have to pay substantially more of their earnings, right, to service their debt. So now that business, which is valued on its profitability, right? If we're saying this is $1 billion company, then that means, at least using the 10x rule, and there are other ways to value companies, but using the 10x rule, we expect that over the course of 10 years, that company is going to produce $1 billion of value, so $100 million a year of profit, right? If our debt service increases, right? Let's say we have $500 million worth of debt, $500 million worth of debt in this company, and the debt service doubles. So we were paying 50. Let's say we were paying, I don't know, what were we paying? We were paying $15 million a year or something like that to borrow the 500, right? And now we're paying $65 million to borrow that same amount of money. Well, that's $50 million of increased expense to the company, and the company was making $100 million. So now the company makes $50 million. Okay, so now when you go to the market and value the company is not $1 billion company anymore. It's a $500 million company, right? So half of the value of the company has been erased by this increase in interest rates cutting into the company's profitability. And because of the other factors in the economy, right, because of the inflation, right, we have a situation where buying power is shrinking, right? And shrinking buying power is being coupled with rising interest rates, which reduces people's buying power. So you're being hit with a double whammy where the market, right, buyers and consumers and wholesalers and retailers, all these people are able to afford less stuff, right? And so they're able to afford less things, right? But you're getting the prices increasing, even though people are buying less. So supply and demand are kind of uncoupled from each other, right? You have decreasing demand, you have decreasing demand, but your price continues to increase rather than fall, right? And demand should move with supply. Supply is not moving, so if demand goes down, we should have less price, right? Because supply versus demand. And so this happens to a bank like SVB, where their balance sheet was healthy, right? Maybe a year ago, 2 years ago, when these businesses' debt service costs were very, very low, right? Because the interest rates were very, very low. And now that the interest rates have been increased rapidly, all of that value just disappears, right? Because the value is only on paper. And now, will that value return? Will those assets be worth $1 billion each again someday? The answer is yes and no, right? For the businesses that survive this crunch, absolutely, they probably will. They might even be worth more. Some of them may go on to be incredibly, extraordinarily valuable companies. That's obviously hard to say. Obviously, if you have 100 companies, probably one of them will be, a big hit, and some of them will be failures, right? Over time, right? But the problem is that the bank needs the money today because the depositors are demanding their deposits today, and so they can't wait until those companies are worth, what they're going to be worth in the long run. They need to pay out now. And so that's how these banks get into trouble. And that's how interest rates are affecting business valuations and banks' balance sheets, right? And they're not just affecting banks' balance sheets. Obviously, they're affecting everybody's balance sheets, anybody who's buying and selling these types of assets, which should be everyone. Not all of us participate in, say, the stock market or in the real estate market. But you should, right? So it's the best way to allocate your money. But this is what happens is now these valuations fall, the bank's balance sheet becomes much, much weaker, right? And now the assets that it was relying on to draw against to pay out its depositors is not there. And so the bank becomes insolvent, and you get people going to their bank in New York to withdraw money and being arrested, right? And this will probably happen to more banks because that squeeze is there. And it's kind of a trap for the banks falling. Now, the bigger a bank is, the more diversified it is, it may take a loss on its bottom line, but it is less likely to feel the brunt of these effects, right? SVB was special in that it specialized in these types of businesses where the risk was higher, this particular risk, and obviously they're reaping the rewards of their strategy. There are other banks who've probably targeted similar investments, a similar asset mix, who may also be in trouble. There was an article I read maybe 2 weeks ago in the Toronto Star, and they were saying that CIBC, was it CIBC? I think it's CIBC. Let me not even rank one of the big five banks. I think that was the one, but I'm not sure. Was reporting that wasn't reporting, but by the numbers, about 80% of their variable rate mortgages were people who were now underwater, right? Who were losing money on the valuations that they had. Not losing money on the valuation that they had. They were losing money at the rate they were paying for the house. So their payments had grown to a point they couldn't afford. And so they were now using credit products to maintain their lifestyle, hoping that, obviously market conditions will improve in the future and they can go back to affording their mortgage, right? And of course, lots of people, or at least some people, will definitely be able to do that, make that float, and other people will reduce their consumption again, right? They're gonna buy less, save more money to try to avoid going into debt to pay for their lifestyle and keep their home. And then, of course, many people maybe will not keep their homes. And so this is very relevant to real estate investors because homes are one of those assets that these banks are heavily invested in by way of mortgages that are at risk when interest rates increase like this. Now, Homes are indirectly affected by the inflation because the people in the homes are losing buying power, but they're not businesses. So the inflation causes businesses' products to be demanded less because they're more expensive in the eyes of us, right? It costs more for me to buy eggs today than it did last week, so maybe I'll buy less eggs. Maybe I'll skip them this week, whatever, right? That's the inflation on me. On a business, it's a bigger deal because they have to buy inventory. They maybe can't skip buying the eggs, right? They just have to pay more for them, and they can't necessarily charge me more for them because I'm fed up already, and blah 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 blah. So the business is going to get squeezed in that regard. The individual, the homeowner, the worker, the whatever you want to call the person, they also get squeezed because now the business that they work for, right? Well, that business doesn't need them, or it doesn't need somebody, or it doesn't need a few somebodies because they're not selling as much product. So now you get layoffs, right? And that's the thing with a business. A business is not like a household, right? A household tries to cut back on consumption of things to save money. A business also needs to cut back on the consumption of things, but the things it consumes on is primarily payroll, paying people to do things. So it has to cut back on employees. And typically the way the job market works is a business will not approach all of its employees and say, hey, we need to cut 20% across the board. A business will cut 20% of its employees. And so 20% of its staff go from having an income to having no income. And so that sharply reduces their buying power, right? As opposed to just slightly reducing it because now they don't have an income. And all those people flood into the job market. So now you have a lot of the competition in the job market, which makes it a buyer's market, right? It makes it good for the employer, an employer's market, right? But you have an oversupply of labor, and so that harms the economy even more because those people can't demand, which means the businesses have nobody to sell to, which means that things get worse, so they lay off more people who then can't demand, and you see how the cycle repeats itself. And the cycle can and has repeated itself all the way to the point where basically your economy stops. This is the heart attack that I mentioned earlier. Enough people have lost their job and their buying power, and there's not enough buying power in the economy, that suddenly large swaths of the economy just are not receiving the cash flows that they used to. And essentially, like a heart attack, those parts of your body that are starved for blood die. Those parts of the economy that are starved for cash flow likewise die or are disrupted. And I mean, there's bailout programs and things the government tries to do to try to alleviate the damage. Depending on your economic school of thought, you're either right or wrong on the subject. The Keynesian school of thought, you probably hear about Keynes on the news if you ever listen to them talk about these subjects and things like quantitative easing and things of that nature. The Keynesians, Keynes being, he was a famous economist, the Keynesians believe that the government can step in and intervene and correct the market to help out. And so that's the idea of having bailouts. That's basically a Keynesian idea. And Keynesian economics is more or less what we've been practicing for quite some time. It's a modern take on it, so you can't put all the blame on him. But that's kind of the philosophy we operate under, and it seems to me like it's the wrong philosophy. But that's my opinion. I'd more agree with the Austrians. In Keynesian theory, you're gonna have the government step in. It's gonna offer lines of credit or free money in the form of bailouts or transfer payments to portions of the economy that becomes starved for cash flow. At least that's the theory, right? And so by doing that, you're essentially, it's like a cash flow life support to those areas of the economy until you can unclog, the whatever caused the heart attack and restart things, right? That's the theory, and it's a beautiful theory, right? It's a beautiful theory, And, in like some sort of computer mathematical model where things happen and propagate instantly, it works. I'm sure. I'm certain of it. The real world is not a computer model. Things do not propagate instantly. It's analog and it's messy, and processes that seem like they should be easy on a spreadsheet oftentimes are not. And so I think that these programs typically just result in more. I think they result in moral hazard. But my moral stance on whether or not bailouts are a good thing or not, it's probably not important. Probably most people don't like them, probably because the perception is that they go to the wrong people. It really doesn't matter who you give bailouts to. It's a bad idea. We certainly saw this during COVID with the, I guess it was CERB payments in Canada, whatever they called them in the States, whatever they call them all around the world, where they paid people to stay at home and not do anything. And not only were those a bad idea just from an economic perspective, because you're stealing from the future to give to the present through this really inefficient system of government that takes like 35% off the top through waste, corruption, and blah, blah, administration, I guess. So it's just kind of a silly plan. But aside from that, you end up incentivizing people not to work, which I can't speak for the country, but here in the GTA, we definitely saw a shortage of labor during that time. And obviously, some people would say, well, yeah, that was our goal, to have people stay home and not work so they don't spread COVID. And in this sort of technocratic scientism view where we're going to engineer society and turn the levers and control the outcomes, they were somewhat successful in their strategy, certainly. The problem with their perspective is not so much that they were unable to predict the outcome, right? Like the core of science is we arrive at a hypothesis that allows us to predict the future. It's what everything, business decisions, physics decisions are based on. I mean, people sometimes go by feel, but if you're going to really try to understand the world, you have to be able to make predictions that actually predict what's going to happen, right? That's how rockets and cars and everything works. And so this viewpoint that we're going to pay people with this Keynesian perspective that we're going to jump in and kickstart the economy and take care of the portions that are neglected while we fix, the pipes, so to speak, correctly predicts that, okay, we can jump in, for example, and reduce the demand for labor or for jobs, let's say, by paying people to stay at home. They were correct. Unfortunately, they're incorrect because they didn't predict, or for those that did predict, they completely ignored the consequences, the negative repercussions of this, right? Whether that is harming businesses by starving them of labor, which increased their expenses and was yet another vector for different types of businesses to be embattled. And the types of businesses that are most harmed by labor shortages and increasing labor costs are small businesses, because they're the least able to absorb the cost increase. Right, so you're harming the moms and pops or whatever of the world, right? The people who have small businesses, and small businesses account for a large proportion of our economy, so they're not insignificant. Those are the people who get squeezed in that situation. Pardon me. Those are the people who get squeezed in that situation. And so you made these transfer payments. You didn't predict that you were going to harm these businesses. The harming of these businesses means some of them go out of business or lay off staff, or they hire fewer staff because they can't afford them, which then again leads to your problem of higher unemployment. And then that doesn't get into fraud and corruption and et cetera, et cetera. There's lots of money that, was supposed to go to one place or another, but did not. Ended up in the hands of people who were connected, et cetera, et cetera, et cetera. So there's lots of waste in that regard as well. And so those things all hurt, from my perspective, the Keynesian approach, their argument that, oh, well, we can just step in and sort of do a little surgery on the economy and then have it kind of chug right along. That little surgery that they're talking about is actually this big, messy, drawn out process where ultimately you oftentimes end up taking money from the people who need it most to give it to the money who need it. To give it to the people who need it the least, right? And that's what we saw with things like CERB and those transfer payments during COVID. We took tax dollars that are funded primarily by the middle class to then pay the middle and lower class these checks, right? But the middle and lower class were in a state where they either were being kept from work by lockdown orders or they were continuing to work, but they're normal people who have about $500 saved away for an emergency. And so they spent the income that they were given. And where did they spend it? Well, stores were closed. They didn't go to the mom and pop. They went to Amazon. They went to Walmart, right? They went to those big brands and companies that were able to operate through the pandemic without issue. And they made Jeff Bezos the richest man in the world again, right? So that's a perfect example of where you're making these transfer payments. Your intended goal is to help one group of people, which you do sort of accomplish because they use that money. I mean, it gets consumed. They bought stuff from Amazon to make Jeff rich. It wasn't just, he didn't just vacuum up their money. But ultimately, probably most of the items that they bought were consumatory items anyways, perishable goods, a lot of wasteful luxury goods, etc., etc. We saw during this time the price of luxury goods, Louis Vuitton, that sort of thing, skyrocket because you had a whole bunch of people who, because we indiscriminately gave away checks, we gave away checks to a lot of people who weren't very financially responsible or literate. And so rather than seeing the money they were given as an opportunity to, improve their situation, make an investment, save for the future, they took that money and were like, oh, shoot, I've got an extra $500 this month. I've got an extra $1,000 this month. I've got an extra $2,000 this month, whatever it is. And they bought shoes and they bought a watch or they got a car that they couldn't afford, which also cars, right? The prices of cars increased greatly during the same period for many of the same reasons, right? You induced labor shortages. Those labor shortages induced parts shortages. Those parts shortages induced vehicle shortages. And then those vehicle shortages meant that when you went to go buy a car, there were no cars, or the cars that were available were very expensive, or you could order a car, but you had to wait for a year for the car to get to you, or 6 months for the car to get to you, right? So these are all the negative consequences of those market conditions, right? The high inflation, high interest rates together, right? Hurting businesses and consumers alike, basically the entire economy, and kind of choking the economy. And so as real estate focused individuals, we're obviously very aware and sensitive to the interest rates, right? Because those are affecting the profitability of our assets, right? But this means if we see more market action like this SVB bank, if we see more banks or financial institutions faltering because their asset mix on their balance sheet is not good as for these reasons, then we may see that spread to mortgage holders, right? And if we do, we may see widespread defaults, much like we did in 2007. Now, America is very different from Canada, so they may see widespread defaults and Canada may not. That is what happened in 2007. Canada saw defaults and may still, but maybe not widespread. It'll be interesting to see, and it will depend on each market. But therein lies an opportunity for savvy investors who should be preparing financially to maybe execute a purchase or two in the coming, I can't give you a timeline, 3 months, 6 months, a year period where where the chickens come home to roost, right? Where the negative ramifications of the high interest rates and the high inflation coupled together starts to actually negatively affect the economy, right? And so that's a fantastic opportunity. And so obviously you've got to understand, right? You're for streams on your properties and how those fit together, right? And you've got to understand what you're looking for in an asset, in terms of physically what kind of property do you want, where do you want it, how much do you want to pay for it, how much do you want to make in rent from it, approximately, and then wait for the market, wait for the market to come to you, so to speak. And if we continue to see defaults in the wider market, then we know that that's probably what's coming. So it'll be very interesting to watch. I mean, watch is probably the wrong term. I'm not much of a market watcher, but to hear about the developments that come in the next couple of weeks and months, to see where exactly the economy is going. Obviously, there is, there's a lot of factors. Economies are big things; they're not monoliths, and so interest rates will affect a lot of things. Government spending affects a lot of things, and so that'll be interesting because they're semi-fighting a war in Russia right now, or I'm so sorry, not Russia, in the Ukraine, against Russia right now. And however that's going to play out, but countries like the United States and Canada are sending weapons and stuff to the Ukraine, and those cost money. You got to pay for those. Even if they're part of our military stock, let's say, right? They're just vehicles that our army has, and we're just going to give them to Ukraine. Well, okay, but our army still needs vehicles, so they need to be replaced, right? So there's going to be some arms spending and stuff like that, and that's good for the arms industry and the industries that support it. So there's winners and losers in these things, right? We may see interest rates continue to climb and that continue to hurt businesses, while also seeing the arms industry do really, really well as violence escalates. And obviously, well, I don't know if it's obvious, but certainly I hope that doesn't happen. It's a terrible thing those politicians have got those young men into, on all sides. This is people like to act like violence is blameless if you're the side that chooses to indulge. And like, both parties are always guilty when you choose to indulge in violence. Like there's no, in theory, you can walk away, right? Turn the other cheek and all that. I don't know if that's always the most practical advice for an individual, but for a country, that may actually be sound advice. I don't know. It's not my life, so it's not being sacrificed. I wish my politicians weren't sending our stuff for their war. It doesn't seem like a good use of my money, and it doesn't seem like seems very unfair to Russia that we're gonna send weapons to their enemy and then be like, yeah, but we're cool, we're neutral, we're not a part of this. We're just gonna give them a bunch of guns and bombs and stuff, but we ain't got nothing to do with this. Seems disingenuous, but I don't know. I'm not a political commentator, so it doesn't matter. But yeah, really, that's all I wanted to talk about this week was the Silicon Valley Bank and its closure. I thought that it was a very interesting case study in, I guess, the anatomy of a bank run and how an institution like this in the economy fails, right? And what that kind of means, what it signals, trying to understand the implications of this type of bank failure and understand how it's going to affect the market. And like I said, it's by itself, it's not really indicative of much. You could chalk it up to a poorly managed bank and pretty much be done. If we see this happening to other institutions, then you have a wider problem in the economy. And that's probably what we'll see. So this is kind of like the canary in the coal mine. If the coal mine ends up blowing up, we'll look back on this in hindsight and say, oh yeah, that was kind of the beginning of whatever happened. But if nothing happens, then that was just an institution that wasn't very well managed. And the greater context is the rest of the economy is robust enough to withstand the current economic climate. And I know what I would bet on, but either outcome is is possible. I lean more towards the former than the latter myself. But I mean, we will see. I guess time will tell. And watching as time tells, as investors, we'll see that there are going to be a lot of market opportunities, or at least there should be, assuming that this was kind of the canary in the coal mine. So, like I said, we'll have to see what happens in the weeks and months to come, and kind of where that leads to market sentiment, right? Like, how does the market feel about these developments? How does sentiment develop? Because a lot of the economy is about confidence, right? Are you confident enough to put your money into the investment and believe that you're going to get money out in the future? And that's a calculus that you have to do as a real estate investor for a home or a property. And that is a calculus you have to do as a business owner or a business investor, stock market investor, right? You got to say, hey, if I'm buying, $10,000 worth of Tesla today, I hope that it'll be worth $20,000 in 7 years or so, right? When that happens, when that is the case, then that's fantastic and you're happy. And when that doesn't happen and that's not the case, then you're obviously not. And how confident you are in getting the outcome where you get your 7% per year, or your 100% every 7 years, or whatever return you're looking for, your 15% on some real estate deal or whatever per year, then that's when you take action, right? And that taking action puts money into the economy. So the economy is largely based on people's confidence in taking action, right, to put this money into the economy. Now, for many, many people, they do not have the confidence to do this. They're not investors, neither in real estate nor in stocks or whatever, and they outsource this task, right, to quote unquote financial professionals. Right, they give their money to a financial advisor and they put them into a mutual fund, or maybe if they have a really good advisor, maybe they get an index fund or things of this nature, right? And those funds take the money and they buy those risks, same exact thing. So now you maybe aren't measuring your grandmother and grandfather's confidence because they don't participate in the market, but you're measuring the confidence of the guy they hire to participate in the market for them, a la their bank's fund manager or their mutual funds manager, or et cetera, et cetera. So the market is almost entirely down to confidence. That little human component, confidence, is what's kind of underwriting the valuations of everything. If everybody loses confidence in things, then things will be valued less because they won't be willing to deploy their resources. And so it's a very long-winded way to go in a circle and come back to what I always talk about, which is mindset, right? It's a confidence thing. The economy is a confidence thing. The whole thing, it's all about mindset. It's about your attitude. And the thing is that if the market loses confidence, and it does from time to time, it's what we call a recession, right? If the market loses confidence, it's your job as an investor, really, at those points when everyone else is not confident, to hold your head high and say the future is going to be great. That's like the true trick of mindset, right? Is like, in that moment when everybody else is kind of, they keep your child from pooping their pants, right? When everybody else is pooping their pants and worried and afraid, you, the investor, should be saying, oh, the future is bright. Look at these deals. Look how good things are going to get. And more likely than not, you'll be rewarded if your timing is right. If you're in the middle of a confidence panic and you're taking action and buying things, you're probably getting them at a discount. And even if you've not selected the best targets for your money, as long as you're in it for the right amount of time, right? Like your time frame is long enough, whatever that means, depends on each investment, but maybe 5 years, 10 years, whatever it is. Over the long term, you're probably going to make a lot of money off of those decisions, because in that time period, you're going to see a big jump where people are not confident, and so they're, this is the thing about confidence, right? Is if you're not confident, you don't shoot your shot. And if you don't shoot your shot, as Wayne Gretzky said, you miss 100% of the shots you don't take, right? So when people aren't confident, they're not shooting any shots, which means even though there's money to be made and deals to be had, they're missing them, right? And so there's a period where people aren't confident, nobody's shooting a shot, so prices are falling, but there are deals to be had. So if you're out there shooting your shot at that time and buying those good deals, you're going to make a whole bunch of money. And when those people realize that there are deals to be had, they're going to turn around and start shooting their shot. And they're going to now be shooting at the things that you already bought. And so your value is going to jump right up. And so it's periods of economic downturn. If you have the right mindset, if you've done the work on yourself in terms of, having the confidence, competence that is required, and everybody's threshold for action is different, but to have those things in place to take action, right? Then you're in prime position whenever the sentiment turns sour, the economy starts to go bad, to make lemonade out of lemons, right? And that's really what I guess that's one of the things that is A, super duper powerful about investing, and B, super duper hard about investing. It's why there's so few truly successful investors. Is it's very, very difficult to be unshakable. To borrow from Tony Robbins, the title of his book, Unshakable, which is a book about mindset and not just mindset. He also has an investing strategy in there, or philosophy, but about getting your mindset locked in and really being prepared to take action. Or if you're, because many people, the mindset thing is just, it's not going to happen. That is, they're just not that person to get into that headspace to take that action. If you're not the guy, right? That's fine. Be the caddy, right? That's not everybody needs to be out there on the golf course, trying to hit holes in ones. You can be the caddy, and you can get 13% of that guy's a PGA winnings, right? There are other ways to make a cake, and so if you're not the person who's going to take action, you can't get your mindset there, then either surround yourself with people who do take action and, be invited to take action by osmosis, right? Or set up systems in place that take action for you, right? Lots of people don't have the discipline to invest in the stock market at regular intervals in an unemotional, dispassionate way. But many people take advantage of things like index funds to do just that. If I set up a, $500 a month contribution to an index fund that's tracking an index of the stock market, right? The VIX or something, then I've automated taking that risk. So now my mindset doesn't really matter because the computers at the bank are just going to do it for me. So there are ways around. It's still a mindset thing because you have to have the attitude. I'm gonna put this system in place. I'm gonna make it happen, even though I'm not gonna actually sit there and pull the trigger each time. So no matter what, there's some mindset. You gotta have some positivity, some productivity, some tenacity, and really go after what you want. But there are many, many ways to skin a cat, as the expression goes. I don't know why there's an expression about skinning cats. Seems strange, but as it said, there are many, many ways to do that. And so you just need to figure out for yourself, who am I as an individual and as an investor, and what's my strategy going to be? Am I going to go out there and get my hands dirty? Am I going to start a business, become a real estate mogul? Am I going to be a bit more passive, maybe just work at my job and maybe look for opportunities to invest, maybe private mortgages or buy and hold? There's a lot of different roles that you could play as an investor in real estate alone, much less the wider world of investing. To sit there and reap the rewards of your hard-won mindset and obviously doing the work of understanding your markets and your products and your assets, and et cetera, et cetera. But yeah, it all starts with mindset. It all comes back down to confidence. So I thought that was an interesting tie back. I'm gonna end it here. Thank you to those of you who've joined me live, and for anybody who chooses to watch this, after the fact later on YouTube. As always, if you have any questions, they don't need to be about what was in this video here, but just questions about real estate investing, Southern Ontario, etc. Please feel free to reach out by email or leave a comment, and I will try to answer your questions as soon as I can. And thank you very much. Have a great day. Derrière.